If you had put 1000 rands into Capitec Bank when it listed on the JSE in 2002, you would have 2.1 million today. Not 100,000 rand, not 500,000 rand, 2.1 million rand, which makes Capitec one of the greatest investment stories, not in just South Africa, but on the entire African continent. But here is the part that makes this story truly remarkable. Capitec did not build that wealth by chasing the rich. They did not build luxury private banking suites or compete for wealthy clients. They did not offer premium cards or exclusive logins. They built their empire on the people that all the banks in South Africa overlook. And in doing so, they built the biggest bank in South Africa by clients, bigger than all banks that laughed at them, bigger than the institutions that had been running this country's money for over a century. This is the untold story of how they did it, and it starts not in a bank, not in a boardroom, but in a wine business. A quick disclosure before we begin: I'm a customer of Capitec, and some of the opinions expressed in this video are based on my personal experiences as a client. However, this video was created independently and was not sponsored, affiliated, or endorsed or approved by Capitec. I have not received any payment, compensation, or incentives from Capitec for making this video. This video is just intended for educational, informational, and commentary purposes. Any opinion expressed are my own and should not be considered financial advice, investment, banking, or professional advice. Viewers should conduct their own research and consider their own individual circumstances before making any financial decisions, and all trademarks, logos, and brand names belong to their respective owners and are used solely for identification, commentary, and educational purposes. To understand what Capitec built, you first need to understand what South Africa looked like in the late 1990s. The big four banks were enormous, powerful, and very comfortable. They had been running South Africa's banking for generations, and they had a very clear picture of who their customers were. Their customers earned a good salary, had a permanent job, had a credit history, and had fixed addresses, had the right paperwork. If you did not fit that picture, the big banks did not want you. Too risky, too expensive, too much administration for little return. But here's the problem with that thing. South Africa in the late 90s had tens of millions of people who did not fit that picture. Workers who got paid in cash, people in townships with no formal street addresses, domestic workers, farm laborers, factory work, people earning real money, spending real money with real financial need, and absolute no access to the formal banking system. The big banks looked at those tens of millions and saw a problem. One group of men looked at those same people and saw a market. Here is something that nobody tells you about Capitec. The people who built it did not come from banking, they came from wine and spirits. Michael Lee Rolex, one of Capitec's founding architects, had spent his career working for Distel, Africa's largest and biggest liquor company. His business partner, Brian Stessan, had a similar background. These were retail and customer goods people, not bankers, not financiers, not the kind of people you would normally expect to walk into a South Africa's most protected and regulated industry. But that is exactly what made their thinking so different. They did not see banking the way bankers saw banking. They saw it as a way a retailer sees customers. What do people actually need? What are they being overcharged? What is necessarily complicated? Where is the gap between what exists and what shouldn't? And what they found when they looked at South Africa's banking market was this. There was a massive, underserved, largely ignored segment of the population that was being charged enormous fees for basic financial services through informal money lenders and micro lenders. Over 2,500 small micro lending operations scattered across the country, all charging sky-high rates and none of them offering anything close to a real banking service. The founding group, backed by an investment company, PSG, started quietly buying up those micro lenders from 1997, consolidating them, cleaning them up, building the foundation for something bigger. Then on the 1st of March 2001 in Stellenbosch, Capitec was born, and their first product was so simple that the big banks did not even take it serious. The big banks in South Africa had dozens of different account type: a basic account for low earners, a standard account, a gold account, a premium account, a private banking tier, each one with different fees, different benefits, different rules, different treatments. And the more money you had, the better your account. The less money you had, the more you paid in fees relative to what you earned. Capitec launched one account. They called it Global One account for everyone, rich or poor, young or old, first-time banker or experienced professional, same product, same gold card, same service. The last part is important. In South Africa, where status and class are deeply felt, giving everyone the same gold bank card was a statement. It told every customer that walked through that door, you matter. We are not sorting you by what you earn. We are serving you as an equal. But the card was just the visible part. The real innovation was underneath. Capitec priced everything so affordable. Their fees were dramatically lower than the big banks. Then they did something even more radical. They opened their branches on Saturdays and stayed open until 5 p.m. on weekend instead of closing at 3:30 like other banks. That gave working class South Africans, people who could not leave work in the middle of the afternoon to go to the bank, an extra 6-7 hours of banking time per month. 6-7 extra hours from one simple decision about opening times. While the big banks were spending millions on adverts telling poor South Africans they were welcome, Capitec was quietly opening on Saturdays and letting actions do the talk. And then came the pricing move that really shocked the industry. In March 2002, Capitec cut its lending rates by an average 22%, well below what informal micro lenders were charging. Then they kept lowering the rate as they grew, because Capitec understood something that the big bank had missed. If you make banking genuinely affordable, people use it more, and the more usage means more revenue, even at lower margins. Volume was the game, and the volume required trust, and trust required treating people with respect. Clients came first in thousands, then in millions. By 2018, Capitec had become impossible to ignore. They had over 10 million clients. Their share price had risen thousands of percent since listing. The big banks were finally painfully starting to take them seriously. Today, Capitec has 26 million active clients. To put that into context, South Africa has roughly 62 million people. Capitec is the bank of choice for nearly half of the country. Not half of people with bank accounts, half the entire population. They are the biggest bank in South Africa by client numbers, and the other institutions that dominated this country's financial life for a century are all behind them.